Good afternoon. This is Ashok and Chris Cooper with the Realtor Lender Committee, and we put together a presentation about the jumbo mortgage. Chris and I'll be going over some of the features in it. And Chris, as a realtor, are there something special you think people would want to know about the jumbo mortgages?
Well, maybe what an applicant might look like. Why would you use a jumbo loan? When would be the most opportune time?
Okay.
And information about how we can present it to our clients properly with education.
I think one of the things before we go there is that you have three different ways of posting your questions. The first one is where you can go on our site itself on this webinar and post your question. The other is where you can text them either to Chris at 513-519-3912 or to Ashok. That's me at 513-600-4961. So let's just go ahead and start talking about the jumbo loans. So what the jumbo loans comes from the fact that the loan amount is higher than what the conventional loan limit is in a particular area. So in our tri-state area, the conventional loan amount is $417,000, which means any loan above $417,000 would be regarded as a jumbo loan. So if we do some reverse calculation, these days almost all jumbo financing requires a 20% down. So if you have a purchase price of $521,000 and $250,000 or more, that would put you in the jumbo loan category unless the buyer decides to put more than 20% down to keep it conventional.
Why would someone want to do that?
Because there's a perception that jumbo loans are more difficult to get. And also historically, and we'll cover that in a little bit more detail, the rates for the jumbos were a lot higher than conventional.
Is that still the case now?
No, and we will cover that in a slide further. But that's a very good point, Chris, and we'll come back to it. So it becomes a matter of choice. How do you want to do it? Sometimes the jumbo clients, so the people that are involved with jumbo financing, they have special situations. They require exceptions. Almost every jumbo client, particularly if they are business owners or independently wealthy, they do not a lot of times meet conventional loan standards, underwriting guidelines. So then in that case, they would be looking at jumbo. So that's
so there are underwriting guidelines that differ between the two as well. Then.
Oh, absolutely. The jumbo guidelines are not consistent at all. There are no set guidelines. Each bank has its own criteria, and they don't conform to anything. All jumbo loans are portfolioed, which means they do not have to follow Fannie and Freddie guidelines, and they don't necessarily have to come under the supervision of the CFPB.
So in the underwriting guidelines, what premise do they take as far as the appraisal is concerned? Are there any differences there?
Yeah, and we can talk a little bit more about it later.
Okay.
So let's just go up, but that's a good point again, Chris. So when you look at the biggest thing that has happened in the jumbo markets is what has happened to the rates. So right now, if we are looking at this chart, the 30-year conventional mortgage is about 4.375 right now, and the jumbo is 4.5. So the difference between the jumbo and the conventional is only an eighth higher on the jumbo. When you look at the arms, the 7-1 and the 5-1 arms, now you're looking at the jumbo rates being lower than those of conventional.
So while we're talking about rates here, obviously I have an understanding of where the conventional 30-year fixed rate and how that's governed. How is a jumbo rate determined if the banks are portfolioing these jumbo loans?
A good point again. It just depends on the lending institution as to how hungry they are to go after the jumbo market. So in the last 4 or 5 years, the lowest risk borrower is the jumbo client. So suddenly there's a huge appetite for this type of a loan. And so if we go to the next slide, what this is talking about is the spread. Okay? And when we talk spread, it is the difference between two prices. So a spread could be between gold and silver, between gold and oil. So any price that is followed as a differential is called a spread. And the spread in itself becomes something you follow. So over the last 50 years, this is the first time in the history of the jumbo versus the conventional that the jumbo is that narrow on the spread, and in some cases has actually gone negative. So just to make sure that I was looking at it correctly, I called one of our, a friend of mine, he manages a several billion-dollar portfolio in mortgages. And he said in his 35 years, he had never seen this. So this particular anomaly that is existing in the market is absolutely fantastic for the jumbo borrower. It puts them in a very, very unique class as far as buying things.
So how, I mean, is this temporary then?
Oh, who knows?
It's hard to say.
Yeah, because there's no way of knowing. Again, it depends on who wants them to buy. So right now, the institutional money, the hedge funds, the banks are really pushing the supply towards the jumbo market. Okay. So now and this is just very strange in the market. So across the board, different jumbo rates have started defying history. And it's because it's not so much that there's that great a demand for it, it is that there is a supply for it, for the jumbo loans.
Okay.
Okay. So who are the suppliers of this money? These are large banks, hedge funds. They are the primary, maybe even some insurance companies that are funding the lenders. So there are companies like Redwood. Okay. Redwood is probably right now the most prominent lender of jumbo mortgages. They've just got the most fantastic record as far as doing that. Then some of the banks that are in the market are Chase, Barclays, Credit Suisse, Merrill Lynch. All of these are trying to do it. And again, depending on how much they want to push this particular product is how aggressively they will change their guidelines as well as how aggressively they lower the rates.
So let me pose this then. We didn't talk about it. We probably could have. A jumbo loan is primarily used for a primary residential home for a buyer?
Yes.
Can a buyer have more than one at the same time?
Yes. And the guidelines for it, everything in a jumbo loan is by exceptions. Almost invariably, everything is unique.
Okay.
So it just depends on what, and that's why you may have to shop a jumbo loan to 2-3 different lenders.
Would you advise doing that?
Absolutely.
Okay.
It just depends on what the client wants to.
So if you're talking about how fluctuating the rate can be from institution to institution, is the same the fact for the closing costs that accompany a jumbo loan from those institutions?
Closing costs are rarely an issue with jumbo buyers.
So unlike conventional,
yeah, it's
or
just
unlike FHA,
right.
I mean, you're just, what is it, a percentage? I mean, does it even
No,
exist?
because they're going to be whatever they're going to be. They're going to be origination charges. They're going to be the same thing.
But again, they fluctuate from institution to institution.
Probably a little bit, not a whole lot.
I see.
Because the closing costs are just about the same. And the market is becoming so competitive now that to give you an example, okay, this was something that I would have talked a little bit later. But if you've got a guy who's a very wealthy client and he's buying a very big house and he wants his financial advisor to take care of it, well, if it's with a stock brokerage firm, he has a huge account with them. What they're going to do is they're going to cross-collateralize his loan. They're going to use both the home as well as what he has in stocks. And by doing that, they might even just waive the closing costs.
Oh, really?
Yeah. Again, there is nothing standard in a jumbo loan.
So saying that there's nothing standard, could one buy a 12-family apartment complex with a jumbo loan?
No, it's primary residence.
Only
We're
primary
only
residence.
talking about the primary residence right now.
And so a vacation home.
Or a vacation home or a condominium, but it's for their personal use. It's not commercial.
I understand. Thank you.
Okay. So as we were saying, the means by which these banks attract buyers or attract the clients is by the lower interest rates. And then they throw in whatever they want to, depending on how aggressive they want to be.
I see.
So who are these jumbo buyers? Well, the first group is, of course, the ones that we see a lot because of the GE and Procter and Gamble and Cintas and all these people are the corporate executives. And what happens with them for getting financing can be governed by their employment contract. If the company is paying all their closing costs, they don't care about it. If the relocation companies are adding some other incentives, they worry less. Now, if the contract is only for 5-6 years, why would they want to go to a 30-year fixed? So these are things that go into figuring out what they would want to use as a term for holding a mortgage. Then there are the other group are the people that are wealthy in their own right, either through businesses, trusts, and all that. And they have a slightly bigger concern about how much it is costing them by way of an opportunity cost. That could be a big concern for them. And so let's look at a few examples. Three typical choices. A person is buying a $750,000 home. They put 20% down, so their down payment is $150,000. We are not taking into account any taxes, closing costs, or anything because they're going to be the same over the three different choices. Now, if they go with a 30-year fixed 4.5%, their monthly payment is $3,040. If they go with the 7/1 arm, the guy has a 5-year contract or he thinks he's going to be there for 5 years. Just to be on the safe side, he goes with a 7-year. Well, in that case, his monthly payment is $2,800 per month. It's a saving of $218 versus the 30-year fix. And in the 5/1, he's going to save about $303. Now, if we are just looking at these numbers, it doesn't mean that $303 to some of these people does not mean that much money. So how do you translate it and say, well, look, there is another factor to it. Let's look at what you would pay over the next 5 years in interest. So if you're going with the 30-year fix, you pay $129,000, almost $130,000. With the jumbo, you pay $110. I mean, the 7/1 arm, you pay $110, and then with the 5/1 arm, you pay $103 interest to the lender. Suddenly, it's become a little bit more and real money for them.
Well, now, in what amount of time is this?
5 years.
So in 5 years, each one of these represents a 5-year period.
Yes.
Okay.
Of interest that is paid to the lender.
Okay.
Okay. So now suddenly you're looking at it, and it becomes a different calculation for them, right? So this analysis helps them figure out which, rather than just saying, well, this is better or that, or feeling of something about it, it gives them a better perspective. Okay. Another group that people don't understand very often is the VA jumbo. Okay. Now, there is a perception right now in the market that there aren't that many veterans around, and particularly not wealthy ones. Well, we know that the former CEO of Procter & Gamble, who's about to take over the VA, Bob McDonald, was the chairman and CEO of Procter & Gamble, and he was a veteran, right? So if you're looking at a veteran, same scenario, $750,000 price, the down payment is only $83,550 versus $150,000, and the interest rate is better. So suddenly the client is bringing $66,000 less to the table. And for our analysis, if we take that $66,000 and invest it on something that gives them 5% a year, how does that impact the decision between a 30-year fixed and a VA jumbo, right? So when you go to that, in 10 years, the difference is $60,000 in net worth between the two of them. And the more important fact is that of that amount in the VA jumbo, 109,000 of it, or the 67,000 has grown to 109,000 by investing it in the markets. So when you are looking at a jumbo client, a client that is investing in the jumbo markets, they're very conscious of performance of their money. And this could be an important factor in deciding which one they want to go with, right? And in our area, in the tri-state, you can go do a jumbo VA loan all the way up to 1.5 million. Now, a question that begs here is, why would a VA jumbo be better? Well, the guidelines for the VA jumbo are much less punitive than of a regular jumbo, and also they are standard. So you can go with a lower credit score, lower reserve requirements. So a VA jumbo can be a very, very attractive thing for a person who's in that thing. Any comments on that, Chris? Okay. So there are some important things to note about high net worth client. They are distinct from your normal people, and I don't mean it in a pejorative way, but these are people that have choices. They have options. So if they want something and they have the cash, they'll go get it. Okay? Their concerns are not always driven by how much it costs. They can operate on what they want, and that could drive their decision. Okay? So there are things like, do they put less or more cash down? How long do they want to finance it for? I had an interesting conversation with one gentleman. He wanted to do a 3-1 arm. And I said, well, your exposure is so high to the interest rates going up. He said, I don't care. I said, what do you mean? He said, well, in 2 years, I'm retiring from my company. I'm going to get a really high bonus that I have to put somewhere. And when I pay the mortgage off, it helps me with my taxes. You know, so his decision on why he wanted to buy it like that was different than a lot of other people. So you do have to guide your discussions, and you do have to focus on meeting their needs and their goals. It's more important than anywhere else. Which program do they choose? And finally, which offer is the best for them? Which lender is going to provide them the best options? Who do these people rely on for advice? Well, financial advisors. And by that, I mean stockbrokers and people like that. That group historically does not like money to leave whatever money they have under management, they don't like it to leave their institutions. So that is when I was saying that they will cross-collateralize between stock portfolios and all and offer a really attractive rate to the client. But historically, that group also has very poor mortgage departments. So the whole process of getting it done can be difficult. Banks, well, again, it depends on how aggressive they want to be. The clients also rely on the realtors to help them decide what type of a financing. So I think if you're dealing with a high net worth client, you probably are better off knowing a little bit more about the financing and what are some of the issues. And finally, of course, the loan officers. And the loan officers are in a really good position because there is a lot of tools available to them to analyze and propose to the clients and also present different options. So in summary, if you are working with high net worth clients, the financing aspect of it becomes even more critical, and the decision on how you choose it is very, very important because that's added value for the client, and that's what the high net worth clients look for. Now, will you check and see if we have any questions? Just wanted to tell you that our next topic for our next webinar, which will be on the second Wednesday in August, is going to be Ready, Set, Buy, how to manage your credit. And we're looking for some questions. Do we have any yet?
No.
Okay, wait. I think I do see one question here, Chris. And this question largely talks about when you are talking to a loan officer, how do you decide whether the person has had experience dealing with high net worth clients? And I think the best thing to do there is ask for some testimonials, because if they are not experienced in dealing with high net worth client, it will show very quickly. Chances are they might get intimidated and things like that. Can you think as a realtor of any questions?
I think that the questions I primarily had, we talked about in the beginning, and it's understanding more about how the loan is structured, how the financing works, so that we can become educated when we're helping advise our clients on what they may want to consider.
Yeah, and I think, Chris, the biggest thing about there can be two factors, and I've noticed this in the past, that when people deal with clients that are buying a very expensive property and all, there's a little bit of an intimidation factor. You get intimidated that the person is, buying a very big home, but the fact remains that the high net worth clients do not mind paying more if they get the right service. They do not mind paying more if they believe they're getting some value. And that, I think, becomes the biggest proposition for them. I don't believe there are any other questions, and thank you so much for your time. Again, if you think of some other questions later, you can always text Chris or myself, and we thank you very much for your time. Oh, one last thing. The winner of a drawing for 2 tickets to go to the Reds is Joe Panarello of Academy Mortgage Corporation, and he won this because he had given us his card when we were at the Board of Realtors golf outing last month. Thank you very much.